In this week's lecture notes, we'll talk about corporate governance, the professional relationship, workplace issues, and Theory X and Theory Y styles of management. Corporate governance is something that we discussed in a prior lecture, but I want to go over the 5 different components of corporate governance. So remember, corporate governance, and I'll read the definition here, is about oversight, monitoring, and controlling the company's activities and personnel to ensure support of shareholder interests in accordance with laws and responsibilities. So we talked about this theme of self-regulation and imposed regulation. You can think of corporate governance as a form of self-regulation. So companies design policies and they design systems to ensure that the mission of the organization is accomplished, and they also design different policies and procedures to ensure ethical conduct within the organization. So within the corporate governance structure, we have 5 different components here, which you can see. And the 5 different components include, number 1, board of directors. So we can think of management as the people that are in charge, basically the people that make the decisions and run the day-to-day operational aspects of the business. Now, management is overseen by a board of directors. So a board of directors typically would meet, they would review management policies, and they would provide guidance to management. So the board of directors' responsibility is proscriptive and prescriptive. Proscriptive meaning they tell management things that they should not be doing. For example, maybe XYZ company should not be competing in a new market. It can be prescriptive. It can tell management that they should be doing more of something. For example, we should be hiring more individuals that have a certain expertise or knowledge. So, those are examples of the board of directors kind of getting into what's going on within the organization. But board of directors are also very top line, and they tend to look at things from a very high perspective, and they tend to look at things in terms of how well things are functioning. If you look at different dimensions, for example, financial, product, future, past, those are all considerations that are important to a board of directors. The board of directors are also charged with setting up different committees. Okay, so you can think of committees as a very specialized group of individuals that have a specific task. Typically, when that task is accomplished, the committee may disband, or you may have committees that continue on indefinitely. The 3 most common committees are the governance committee. So the governance committee, and I'm going to use the example of levers of control, they're designed to establish things like the mission statement or the code of conduct of the organization. We have the compensation committee. So the compensation committee evaluates performance and designs compensation structures for employees within the company. Finally, we have the audit committee. So the audit committee is a standalone committee. This exists year to year. It's an ongoing committee. They review internal control. So internal control are the systems that you have in place to prevent fraud and misstatements. And the audit committee deals with the external auditor. In the past, you would have management dealing with the external auditor. Now you have the audit committee dealing directly with the external auditor. Another element of corporate governance is this notion of risk assessment. So risk assessment means that we're trying to prevent internal and external misstatements. Right? So a misstatement is basically something that's incorrect. So we have misstatements that are accidental. We call those mistakes. And then we have misstatements that are intentional. Typically, those are known as fraud. So the corporate governance structure needs to look at risk, and they need to figure out, in terms of risk, what is the impact and what is the frequency? So, for example, if you have a risk that has very low impact but very high frequency, for example, let's say that we give somebody the wrong change. We give them maybe a penny too much in change, or we give them a penny too little in change. If we're a very small business and it's not a lot of money, then the impact is going to be pretty small, even though the frequency is going to be very high. Now, you can also have different types of risks that have different configurations. For example, you can have something that has high impact and very low frequency. So an example of a risk with high impact and low frequency might be, for example, some type of natural disaster like a huge earthquake in New York City, right? So that's going to have a very big, large impact, but the frequency tends to be very small or very minor in nature. So for risk assessment in the corporate governance structure, it's most important to focus on things that have high impact and high frequency. So for example, if you have breaches in your security system, if somebody tries to hack into your company's website, the potential impact can be very high, and if those types of attacks occur quite often, that would be high frequency in nature. Also, you should know that a corporate governance structure is going to have a mission statement. So a mission statement tells employees what they should be doing. So should be doing. And a code of conduct typically tells employees what they should not do. And finally, for culture, know that you have explicit culture and implicit culture. So in the weekly discussion write-ups, I saw a lot of good mention of explicit and implicit culture. So make sure you know the difference between the two. From the lecture notes, let's take a look at page 5. So this is page 5 from the lecture notes. This is Exhibit A, Corporate Governance Framework. So we just mentioned that there are 5 different elements to the corporate governance structure. So here you can see a depiction of the 5 different elements. So first we have the board of directors. So you can see that this is the box here. And we know that the board of directors are charged with setting a mission for the organization, vision. They can establish codes, compliance, compensation. These are the different committees that are set up by the board of directors. Okay, so you can see again, number 1 is board of directors. And then in this diagram here, you can look at number 2, risk assessment. So with risk assessment, first step is to identify stakeholders. In other words, who's going to be affected by some type of risk. A risk, of course, we said, is a financial misstatement that's either intentional or unintentional. It can be from the inside or from the outside. We discussed assessing and ranking risk. So risk is ranked in terms of frequency and impact, and then incorporating your assessment into some type of action. So this is the risk assessment component. And then the last 3 components, remember number 3, 4, and 5, they were the mission statement, code of conduct, and culture. So those things form your overall corporate culture. Okay, so you can see in this diagram, we have 1, 2, 3, 4, 5 different elements. And if you go up into the notes here, you can see 1, 2, 3, 4, and 5. Okay, so the next thing we're going to talk about is professionalism. So we're going to talk about the professional relationship, and we're going to provide a full definition of what that means. So when I was younger, I used to think that a professional was somebody who went to college. So I thought, okay, so if you're a professional, it means you go to college and you wear a suit. We hear about professional athletes. So in that case, a professional athlete might be somebody who plays the sport at a certain level, a certain very high level. But as a service provider and in the accounting profession, we're going to talk about what professionalism means. So we're going to talk about the fact that you can have different types of relationships between service provider and client. And in number 4, you can see the different types of relationships. You can have supervisory, contractual, or professional. So our main focus is going to be on this professional relationship aspect. And then we'll go over what that means. So before we do that, let's talk about a couple of terms here. So the first thing we're going to mention is the agent-principal relationship. Okay, so agent-principal relationship is another way of discussing the service provider-client relationship. Okay, so of course, accountants engage in a service provider-client relationship. Of course, the accountant is the service provider, and then of course the client is the public or the firm that's being audited or the company that you're working for. So again, we know that the agent is somebody that provides the services and they receive payment. I want to point out here also that the agent is also the expert. Okay? So they have expert knowledge, and the principal is the customer. They're paying for the services, and they are not the expert. Okay, so of course, if you're a customer, if you are John Smith, if you're the principal, and you need somebody to do your taxes, then you're going to hire a CPA, and that CPA is an agent. They're a service provider. They're getting paid, and they are the expert. So with the agent-principal relationship, the big problem we have is called the moral hazard problem. Okay, so the moral hazard problem states that one person takes more risk because someone else bears the burden of those risks. Okay, so what that means is that in an agent-principal relationship, if I'm a CPA, then I'm going to be doing the taxes for John Smith. Well, you know, it's not really my tax situation that I'm dealing with. I'm doing John Smith's taxes. So John Smith is going to pay me $1,000 regardless of the work that I do, whether I get him a little bit of refund or a lot of refund. Maybe a lot of refund, he might be a little bit happier. But, you know, it's not my money, so maybe I don't care as much. Okay, that's the moral hazard problem. So another example would be management. Management might be encouraged to take more risks if they're the manager of an organization because they're dealing with the organization's money, not their own personal money. Okay, so we call that a moral hazard problem. And a good solution to the moral hazard problem is what we call in accounting having a fiduciary responsibility or fiduciary duty. A fiduciary duty is simply a duty to care as if the matter were your own. Okay, so if I do somebody's taxes, then I should not have the attitude that I'm not going to care because it's not really my money. You should have the attitude that you're going to care even if you do somebody else's taxes because you're going to act as if it were your own taxes and your own money at stake. We call that a fiduciary duty. Okay. We'll see in just a moment that a fiduciary duty is actually one of the hallmarks of having a professional relationship. Okay, so let's define some other terms here, and then we're going to define these 3 different types of relationships that you can have. So first thing is input. Okay, input is the work that is being done. Okay, so you can see here it says service provider or agent's effort or skill. Okay, so if you hire somebody to do gardening for you, if the person is outside, you know, actually sweating, digging a hole, planting trees, that's all of what we call input. Output is the final product or result that you're paying for. So if I'm paying a CPA to do my taxes, the completed filed tax return is the output. If I am paying an accountant to provide an audit opinion, The written audit opinion, the final report, is the output. If I'm paying somebody to do gardening at my house, the manicured lawn, the new trees and flowers that they planted, that's the output. We can also say that output and input can be verifiable or unverifiable. So verifiability is this notion that the average person, that the average individual can assess the quality and performance. Okay, so for example, if I'm paying somebody to remove a tree, I just want the tree to be gone, I want you to clean up all the branches and then take everything away. I would say that the output, the end result, is verifiable because the average person can go outside once the landscaper is done doing the work. They can look and see, okay, there's no more tree, everything's been cleaned up, looks fine. That's verifiable. Typically, simple tasks tend to be verifiable. Unverifiable means that the average person cannot assess the quality and performance. So, as an example, if you're a CPA and you do a tax report for somebody, or if you do someone's taxes, then I would argue that the output, the tax report that you generate, is unverifiable to the average person because the average person doesn't know whether you did a good job or not. They can't really tell because they're not an expert. Okay. A couple other things I want to mention is loyalty. Okay, so loyalty is very important when the frequency of relationship is often. So if you are, for example, a restaurant, then you rely on customer loyalty because you want people to come back over and over again. So customer loyalty, client loyalty is very important when the frequency of interaction is very high. If the frequency of interaction is low, then reputation is more important. For example, if you are going to get married, most people hopefully get married just one time. So if you're looking for a wedding photographer, then that's a relationship that you're going to have with a service provider where it's low frequency. You don't do it all the time. I'm only going to get married once, so I need to find a photographer one time. Okay, in that case, what's important is reputation. You're going to look at the reputation of the service provider and use that as a guide to determining whether you're going to engage in business with that person. Okay. And we can see that professionalism, typically, the frequency tends to be low. Okay. So most people, when they do estate planning, maybe they only do it once. Okay, so that's an example of low frequency. Or if you make a will, probably you don't do that every week, right? So you only do it maybe once, and then maybe you change it in the future. But typically the frequency is low, right? But exceptions can exist. Okay, so if you hire an accountant on retainer and you have them do payroll, then the relationship frequency is going to be more frequent, right? It's going to be every 2 weeks when you pay. Okay, so let's take a look at these different relationships. So we'll fill these in just a moment, but let's take a look at the exhibit that I have for you here. This is exhibit B, B as in boy. This is on page 6 of 9. Okay, so this is a depiction of what type of relationship the client and service provider can engage in. All right, so we have input here and output here. Okay, so in this matrix, input, remember input means the work that somebody is doing. Can the average person assess the quality of the work that somebody's doing? Yeah, perhaps. If you're paying somebody to shovel snow in the wintertime, then I can go out and watch the person shoveling snow. I can see, are they being productive, or are they just taking a break and drinking coffee and doing stuff on their phone, right? So I would say that if you are monitoring somebody that's shoveling snow, the input is verifiable. Input in some cases is unverifiable. So if you're a average person and you're hiring an auditor to do some work, if you watch the auditor doing work, if you watch the auditor's input, can you evaluate if they're doing a good job or not? Maybe not, right? Because if you're the client and I'm not monitoring like exactly what the auditor is typing on their computer. I'm not really familiar with what they're doing. Even if I did see what they were doing, I'm not really sure if they're doing a good job or not. That would be unverifiable input. Okay, so I want to point out that input can be verifiable or unverifiable, and there's degrees here too, right? Some things may be more verifiable and some things may tend to be less verifiable. Let's take a look at output. Output means the end result, the final product, the deliverable. Can the average person assess the quality of the output? That would mean verifiable. Can the average person not assess the quality of the output? That would be unverifiable. I would argue that if you pay somebody to shovel snow, the average person can tell, okay, is this a good job? Is all the snow, has it been removed from my driveway? Okay, I can verify the output. If you're paying somebody to do your taxes, if you look at the tax return that's completed, can the average person tell whether it's a good job or not? If they don't know anything about taxes, that would be unverifiable. Now, in this matrix here, I want to point out that contractual is here and here. So you can see if you can verify the output, a contractual relationship makes sense. Okay, so contractual means verify the output. Okay, so contractual relationships basically are saying, do whatever work, do whatever you need to do. I want you to fix my car. So if you pay somebody to fix your car, you're not going to watch them fixing your car typically. You're just going to let them do what they want to do. And then when you come back, the car should be fixed. It should run. And if it was making a weird noise, the noise should be gone. Right? So that's output that's verifiable. If you have output that's verifiable, you can see a contractual relationship makes sense. What about supervisory relationship? If you can verify the input, then a supervisory relationship makes sense. Supervisory basically means monitoring people. If you ever worked maybe retail, or maybe if you've ever worked in a factory, some places have like a punch card. You have to punch when you come into work and punch out when you leave work. And maybe there's cameras watching you, right? So in that case, the individual is being monitored, they're being supervised. And supervision is a good service provider client relationship method to have when input is verifiable. Okay, so that leaves us with this last thing here, professionalism. Professionalism means that the input is unverifiable and the output is unverifiable. So we can say that a professional relationship requires expert knowledge. So if you are a CPA, then you have expert knowledge that the public doesn't have. So even if the public or your client were to monitor you doing the work, they would have no idea what you're doing, unverifiable. Even if the client were to look at the final end result, like your work papers or your report, they really don't know whether you did it correctly or not because they don't understand accounting. So output is unverifiable. In that case, professionalism is extremely, extremely important. Okay, so with that being said, let's go back up and then let's fill in the notes from the first couple pages. Okay, I'm back in the notes. This is back on page 2. Okay, so page 2, number 4. We can say a supervisory relationship is where you verify the input. Okay. Contractual is where you verify the output. And a professional relationship is when the input and output cannot be verified. Okay, so professionalism, if you cannot verify the input or the output, it means that the service provider must act with fiduciary duty and the client must trust the service provider. Okay, this is how a professional relationship works. And the result of using a professional relationship is that overall economic cost is reduced. Okay, so think about if you go to a doctor. If you do not trust the doctor, okay, maybe some people don't, but let's use this as an example. Maybe if you don't trust a doctor and the doctor does not act in your best interest. For example, a doctor says, oh, I need to go on vacation, so I'm going to tell somebody that they need an operation even if they don't need it, right? Obviously, that's not professional. But if we lived in a society where that happened, then people would actually try to get a second opinion, third opinion, fourth opinion, fifth opinion. You can see if that were to happen, if you had a society that operated that way, it would increase overall economic cost. Okay, let's go back to the exhibits here. Okay, so we did exhibit B. Let's take a look at C real quick. Okay, so C is relationship frequency. Okay, so we can see repeated or one-off. Okay, I mentioned already that if you have a one-off relationship, right, reputation tends to be important. Okay, so reputation is important if it's one-off. Okay. If you have a repeated relationship, like you deal with the service provider often, right, like if you go to a restaurant, like and you're a regular there, then loyalty is very important. Okay, so we have one-off and repeated. But this matrix adds a couple of other dimensions in here. Client interaction. Client interaction means that you can tell if other people are happy with the work that's done, right? So if I'm trying to hire a photographer for my wedding, can I tell if other people are happy or not? Well, I guess I can use Yelp, and if I can verify, then you can see that reputation becomes more important. So that's listed here. Here, we can say the classic example of professionalism is when you can't tell if other people are happy. I have a very unique tax problem, so I really can't go on Yelp and then try to figure out, oh, what if I have a Section 179 tax issue? Well, Yelp really maybe isn't going to tell me who's going to be good at dealing with that very specific problem. So the classic example of professionalism is when client interaction is unverifiable and relationship frequency is one-off. One-off means it's not very frequent. Okay, so this is just a guide here. Okay, these are not hard and fast rules, right? This is just another depiction to help explain professionalism. Okay, so it's not, these are not hard and fast rules. Okay. Let's take a look at the next page here. This is page 9 of 10. We have Exhibit D, types of relationships. So I'm going to put the answers for you, but let's do just a couple of these together. Okay, so for each example, we have a client-service provider relationship. And you have to identify whether the relationship is going to be supervisory. Remember, supervisory means you verify the input. Is it going to be contractual? Remember, contractual is where you verify the output. And professional. Remember, professional is when you cannot verify the input or the output. Okay, so it depends on how you think about these. So let's go over a couple together. What about a mover? Okay, so think about if you're going to move. I don't know about you, but if I'm moving the purpose of hiring a mover is to make your life easier and more convenient. So I might say, okay, I want you to move all of my stuff from my old apartment to my new apartment. Okay, so if you're me, then you hire the mover and you say, okay, just do the job. I'm going to go sleep in. I'm going to go to my sister's house in the meanwhile. When I come back, I expect all my stuff to be moved out of the old place and put into the new place, and everything should be there and nothing should be broken. In that case, I'm not monitoring the input. I'm not watching the movers, but I am monitoring the output. I want to make sure that my old apartment is empty and everything is unbroken in my new apartment. So in that case, you could say that you have a contractual relationship. Okay, so again, you can argue maybe some of these a little bit one way or the other. So if you have a different answer, then feel free to put it in the discussion so I can look at it and then make edits if necessary, or if you have questions, let me know. Okay. Physician. Physician, the input. When the physician listens to my heart with a stethoscope or looks at like x-rays or charts, I'm not really sure what they're doing. So I can't really evaluate the input. I can tell if they're nice to me or not, but that's about it. That doesn't mean if they're not nice that they're a bad doctor and they don't know what they're doing, but input may be unverifiable. Output, if they say you should take this medication or get this procedure or you're diagnosed with X, Y, or Z, I kind of don't really know like whether they're correct or not. I don't know the output. So here I would say a professional relationship is appropriate. All right, so go ahead and do this, and then I'll put the answers for you online. Okay, we just have a few more things to go over now. Okay, so we've gone over the most important stuff. Okay, in the textbook, in chapters 8 and 9, they talk about employment practices. So there's a lot of mention of employment, and this week we have a case study which discusses employment issues which you can write about in the discussion. But just know a couple things. Know that with employment, there are 3 steps: screening, testing, and interviewing. So in the screening process, we have a description and a specification. Okay, so this here is where we try to figure out the minimum required characteristics for the job. Okay, so what are the minimum requirements? So we may describe what the job duties are going to be. So we want somebody that's going to work 40 hours a week. They also may have to work on the weekends. Okay. We want somebody that's going to be doing accounting work and a little bit of payroll work. Okay. So we're telling people what we expect from them, and also we're explaining what qualities they have to have. For example, the person that we hire must have a associate's degree, bachelor's degree, or a master's degree. Right? The person must have 2 years of experience working in accounting. Okay? And then a lot of companies have preferred qualifications. So I don't know if any of you work in human resources, but the preferred might be, we prefer people that went to school at American University, right? Because that's the best school. So if you have that, that's even better. Once we screen individuals, then we can go to the next stage, which is to do testing, right? So some companies have testing and other companies don't. But the thing you need to know about testing is that when you do a test, for example, you have your employees, potential people come in that might work for you, you have them take an accounting test. The test has to be valid, so it has to measure something important. Okay. So an accounting test measures whether they know debits and credits. That's important to know. So that's a valid test. It also has to be reliable. So it has to produce results that can be counted on. Okay, so if I have an accounting test and it's designed so that I'm measuring whether they can do debits and credits, so that's valid if I'm hiring somebody to be an accountant. And the test is reliable, so it actually identifies people that are good at doing debits and credits, and then it eliminates people who are not good at doing debits and credits. Also, the third step is interviewing. Okay, so interviewing, we know that when you come in for an interview, there's different types of interviews. Some interviews are situational, right? So they may ask situational questions. They try to find out more about your background. Okay. Okay. All right, a few more things I want to mention. Discrimination. Okay, so people think that discrimination is always illegal. Okay, and surprisingly, it's not always illegal. Because for discrimination to be illegal under the law, you have to discriminate against somebody that is of a particular group, class, or some type of category. Okay, so if you discriminate on the basis of race, on the basis of religion, on the basis of veteran status, right, on the basis of age, right, then you're discriminating against somebody that's a protected class or protected group, and that's illegal. If you discriminate against somebody that, again, is of a protected class, we know that that's illegal. And then here is a partial list. This is not a complete list, but a partial list of protected classes. So you can see race, gender, national origin, pregnancy, right? Age. Okay, so if you're like 45 years old, you're considered a protected class. You're under the law, they consider you to be old. Okay, so I don't know how I feel about that, but that's how the law works. Okay. Now there are some examples of legal discrimination. Legal. Okay, so the first thing I want to point out is legal discrimination includes people that are not a protected class. Okay, so let me give you a real-life example. When I was younger, I think I was 14, I tried to get a job working at Burger King. Okay, so I went in and tried to introduce myself, and I spoke to the manager. And the manager told me that they are not going to hire me because I'm too young. Okay, so they said, "You're too young, we will not hire you." I was discriminated against because I was too young. That was legal because being young people are not a protected class. Okay, so they could do that. That was their policy, and that was okay. Right? I was not very happy about it, but it was what it was. So that's a form of legal discrimination. What you should know is that legal discrimination is based on a utilitarian approach. Okay, so utilitarian means that if we discriminate against young people, we don't hire somebody to handle the cash register unless they're at least 18. Then you're discriminating against people that are under the age of 18. We're doing that because we're trying to make the greatest number of people better off. A good example of that would be what we call a BFOQ, bona fide occupational qualification. Be aware that a BFOQ is based on public safety considerations, and it's based on reasonable necessity. And third thing, note that it's very narrowly defined. So it's used in certain very narrow circumstances. So for example, a BFOQ might mean that if you're going to be an airline pilot, you cannot be over the age of 65. Okay, so if you're over the age of 65, then you would think, okay, well that sounds like illegal discrimination because you're discriminating against people that are older. But the law will allow you in this case to legally discriminate against that type of person because it's a public safety consideration. We need people that are younger with faster reflexes to fly planes, and it's considered a reasonable necessity. So make sure you know the difference between legal and illegal discrimination. In the chapter, they also talk about privacy. Okay, so in the workplace, there is an abridgment of privacy rights. Abridgment means that your privacy rights are less in the workplace. Okay, so employers actually have a right to monitor your email if you use work email at the office. They have a right to monitor your work laptop. Okay, so that's an abridgment of privacy rights. And the argument is that as long as you have informed consent, then it's okay to abridge your rights. So as long as they let you know that your emails are monitored, then it's okay for the company to do that. And many states have this notion of employment at will. So employment at will means that you can be fired for cause or without cause. Okay, so employment is at will. If you don't want to work here, you don't have to work here. If the employer doesn't want to retain you, they don't have to retain you. Okay, finally, the last thing I want to talk about is theory X and theory Y. So if you took psychology, a lot of people know about theory X and theory Y. And theory X and theory Y are theories on how to motivate people. Okay, so theory X is an authoritarian method for motivating people. Okay, so we typically say this is top down. Top down meaning you tell people, okay, you need to do this, right? You have to follow orders. That's theory X. Theory Y is more participative. And we also consider that to be bottom up. Okay, bottom up means that you let people from the bottom participate in the decision-making process. Okay, so we have theory X or theory Y. Now, which one is more appropriate? It depends on the situation. So obviously, if you're running a prison and you're trying to deal with prisoners, probably theory X might make a lot of sense, right? You tell prisoners what they're expected to do, and that's predominantly how you organize the culture within that entity or organization. Theory Y would make sense if you have a company like Google, where you want to have as many ideas as possible. You want to foster innovation. So you want to solicit feedback from people at the bottom and let them participate in the management process. Theory X and theory Y has a lot of implication with corporate governance, because if we look at this last exhibit here, exhibit E, this is on page 10 of 10, I want to point out here, when you have corporate governance, when you generate an ethics program, right, we can have theory X, right? Theory X is telling people what to do on the outside, right? It's authoritative. We can use that as a proxy for imposed control. And theory Y is more participative. You know, what do you think you should do? We're going to empower you to make your own decisions. That's more self-control. If you look at an ethics policy or ethics code of conduct, you can see where the policy is going to fall on this spectrum of theory X versus theory Y. For example, if you read a policy and it says, you must obey these rules. I'm telling you what to do, you have to obey these rules. That's more of a theory X signaling approach. What if somebody tells you, these are the principles that we stand for. Principles indicate this is what we are and this is what we stand for. I want you to be empowered to make good decisions. You decide what you should do. That's more of a theory Y signaling method. And then you can have something in between as well. Now, I want to add on one last thing to this discussion of ethics program and signaling. So ethics programs can be, you can see here, compliance-based, right? So compliance-based tends to be about preventing, detecting, and punishing violations. So we're going to lay down the law, and we're going to expect people to follow the law. Okay, so that falls into line with this theory X notion. We can have ethics programs that are integrity or values based, right? So we stand for honesty, integrity, right? You can see that the AICPA Code of Conduct was somewhere probably here, right? Integrity or values based. Satisfaction of external stakeholders. So here we are worried about the improvement of image and with relationships to our customers. Some ethics programs are about protecting management, covering yourself. And some ethics programs can be a combination of these different ones up here. So you can think about the AICPA Code of Conduct, and also you can think about the Ethics Code of Conduct survey paper we're going to have that's going to be due a little bit later on. And these are other things that you can think about and include in your paper that's going to be due later on in the semester. So this concludes the outline for week 4. If you have any questions, please let me know.